Hello, class. Welcome to part 2 of our podcast having to do with rental activities. We're going to start off here in this one looking at the Schedule E. This is where rental income and expenses are reported if they qualify as rental. Remember that if it's less than 15 days, it doesn't get reported, so it wouldn't be here. But if you have to allocate between rental and personal use, you allocate separate and then you put the rental only on the Schedule E. That's important to remember as well. So, top part here we put a description of our properties. Here we talk about the type, and it's just a list to choose from that you have here. And then you put the days. Remember, personal versus personal use versus rental use. This is actually disclosed, so IRS can see what you have determined how to allocate between the two uses. Okay. Remember, if it's a vacation residence, meaning the use is more than 10% of the rental days or more than 14 days, then this can't have a loss on the Schedule E. That is the rule. If it is a residence, the income is limited to the amount of the expenses, and any extra expenses have to be carried forward. Here's where you list your income and the expenses. Notice that depreciation is here, which you have to calculate somewhere else. There's no formula for doing that. You have to reference what we talked about in Chapter 8. Figure out the depreciation. Of course, if this is a building, which most of the time it is, then it is either 27.5 or 40 or 39-year property, depending on the type of property it is. And then this is just the amount of the depreciation. And then here is your loss. Okay. So this is what I mentioned earlier, that you can't deduct losses if you rent out a residence. There's no loss on that. If it's a regular rental, that would then you could have a loss. Okay, so if your personal use is less than 14 days or 10% of the rental property, then it's not a personal residence, it's a rental property. Okay, but there are still some limitations on whether or not you can deduct losses. This only applies if expenses are higher than revenue for the property. So this isn't even an issue, doesn't even come up if there is more income than expenses. So first of all, the at-risk rules. You can only deduct what you're at risk for. This is usually not too applicable to rental properties because it's pretty tough to get a rental property unless you have money at risk. Unless you buy it, you put money up. Okay? So you're not going to you can't deduct more than what you put into the property. Even if you borrowed it, okay? If you're liable, which you're going to have to be in a rental property scenario, then that's the amount at risk. All right. So typically the at-risk rules are not too hard of a hurdle in rental properties. Kind of keeps running. When we get to businesses like partnerships and things like that, we run into more of a situation of things that are at risk. So their example, rather than being rental property, is actually a business. Contributing $50,000, we have a $5,000 loss. The additional amount of risk is $50, but after we lost $35, now we only have $15 at risk. So the next year, when they has a $20,000 loss, they can't deduct all of it because there's only $15,000 left at risk. The other $5,000 has to be carried over until more money is either contributed to the activity or it makes money, so that you can deduct the other $5,000. So that's how the at-risk rules work. Now, much more of an issue typically is the passive activity loss limitations. All right. You can't deduct a loss, and again, this is only about losses. You have to, once you know that you have enough at risk, then you have to look and see if you have a passive activity. And passive activities, well, we'll look at the definition here on our next slide. Every activity under the tax law is either portfolio, active, or passive. You're most familiar with active, wages, and business income. Okay? Portfolio is dividends, interest, and royalties. That's relatively straightforward and not what we're going to spend our time on. Most of the time, we're going to be trying to determine whether something is active or passive. All right, so active is wages, salaries, and material participation in a trade or business. It means you're really involved in the business. That well, we have some rules about that, and we'll see that in a little bit. And then passive. Now, here's why we're so worried about this, okay? Those that are interest and dividends are easy to spot, but determining passive depends on a lot of factors, especially how much time you spend in the activity. Now, if it has material participation, it's active. If it doesn't, it is passive. Why do we care? Okay, because passive income, passive losses can only be offset against passive income. They cannot be used except in very specific circumstances to offset active income. But the other way around, it always works. You can always use active losses to offset passive income. Okay, so notice that not material participate, but also rental activities, and by definition, limited partners in a limited partnership are passive, meaning they can't control what's happening in the business. That makes them passive. Rental activities, by definition, are passive. All right, that's kind of the default. Now, if there are other criteria that could change that, but the default is rental is passive. So what did we mean by material participation? So there's your basic definition, and of course that's so broad as that we of course needed some more specifics. Okay, now if it does not involve rental real estate, then you have 7 tests. Okay, one example of that test is taxpayer works at least 500 hours in the activity during the year. That would make you material participation as long as it doesn't involve rental real estate. Because remember, rental real estate is by definition passive. It has a much higher threshold to get to a situation where it'd be material participation. So, operates a business, does not involve rental real estate. He works 600 hours, then he material participates because he's over 500. Okay, that's one of the 7 ways to pass material participation for those that involve rental real estate. So there are 7 ways to get past that in material participation if it's not rental real estate. There's only one that can get you if it is rental real estate. Now, if it is rental real estate, here is the only way you can be a material participant. If it's more than 50% of your time, and, so notice the and, this isn't an or, and 750 hours. So remember it was 500 for non-rental real estate activities, now it's 750. And they literally, IRS expects when this is challenged, that you have a log of your hours, which most people don't keep, so sometimes that's a hurdle Because if this is a question and you don't have logs or some way of showing your time, then you could be in trouble, okay, for being able to prove it. So if Mandy operates rental real estate business, it's her only business, she works 600 hours, okay, even though she's divorced more than 50%, it doesn't over 750, remember it has to be both, okay, so this doesn't qualify as material participation. So this would be a passive activity. So we're only really worried about losses. Of course, disallowed losses carry forward to future tax years. So, I mean, it's not like it's gone forever, but you can have a rental that loses money, and year after year it loses money, and it just keeps going forward, and you don't get any benefit from that in terms of lowering your taxes. Now, if you have multiple passive activities, you can use one to offset the other. So Chris owns two. He has A that produces income and B that has a loss. So you can use the loss from B to offset the $30,000 of income, and then the $10,000 of B carries forward to future years. Okay, so it doesn't have to, it's not just one activity. If there are multiple rental activities, for instance, you could use the losses from one to offset the other. Now, there's you might say a loophole or a caveat about rental real estate. Remember, our general approach is rental real estate is not material, unless you have a whole lot of hours, this is not a active situation. It is a passive one. But if your income is low enough, there's a special deduction. All right, very limited for those who have rental real estate, and it would be normally passive. You have to still qualify. So let's see how you qualify for that. The special deduction, actively participate. Now, this is not making an active activity. This is just actively participate and own at least 10% of the rental real estate. Now, active participation, okay, just means you're making decisions about renters and stuff like that. Now, why would you care? Because you can have this special deduction. Now, they're known as the maximum is $25,000 loss, and it's cut in half for married families separately. And if you don't live with your spouse, who live with your spouse, and you file it separately, you don't get any. Okay? So active participation is less stringent than material participation. That's what's hard about this. We talk about active versus passive, and then we use this term active when we talk about participation. We notice it's active participation. So that is just being involved with your rental. Management decisions in significant real sense basically means you didn't hire a management company to manage your apartment building. So if you have an apartment building and you hire out a management company to do all the decisions, they screen tenants, they do all that, then you probably don't qualify for this special deduction based on your participation, because you're not having to do anything. You pay somebody else to do that. Okay. Most people don't do that. They do this kind of thing, approve tenants and such, and so they qualify for this. Okay. But remember, it's only up to $25,000. So if your loss is more than that, it doesn't matter. Okay. She actively participates in this example. She can deduct up to $25,000. Okay. Besides the fact that you have to be actively participate. It's only limited to $25,000. It's also phased out. This is and this $100,000 threshold does not change for many years. So 50% of the amount over $100,000, your AGI. So if your AGI is 122, you take the amount you're over the 100,000, multiply by 50%, and then subtract that from the maximum to get how much special deduction. So Mandy could deduct up to $14,000. Whatever the loss is, up to 14,000, no more. Any additional loss would have to be carried forward. All right, these are all kind of calculated on Form 8582. We're going to come back to that in part 3 and look at this in more detail.